For today, right, we will be going through a very simple option strategy called the bull call spread. But I think if for those who are already very expert in option, right, this is like a very beginner strategy, not hard to understand at all, as long as you have basic knowledge on what are call options, what are put options now. Okay. But even if you don't really understand that, you can follow the simple calculation here, you might be able to catch that. So the reason why I'm starting to bring up option strategy is because I do realize that we have been mentioning option for quite some time. We have took some option YOLO trade. So I think the next step is to do some simple strategy. Okay. So we will start with all these kind of simple strategy first. Then maybe who knows, somewhere along the way, we will start to deal with more complicated strategy also. So for today's strategy, right, it is called a bull call spread. So you can see the bull here. You can see the bull here waiting for the phone call and then spreading the leg. Okay. So easy to remember. It's a bull call spread. Let's begin. So what is a bull call spread? So for a bull call spread, right, it requires two option transaction. So normally when we YOLO options, right, we only buy one option contract. So either we purchase a put option or a call option. But when you buy multiple option contract in certain combination, right, you can actually create a strategy and you can limit your risk, or you can actually push your risk reward ratio, all sorts of things. So sometimes, right, it can be more advantageous to actually carry out multiple option transaction to reduce your risk or increase your risk reward ratio rather than just buying one single call or put option itself. Okay, so most of the time, right, the other side of the equation is usually selling of certain options. So as a general rule of thumb, you don't really want to sell naked option. Naked option meaning you just sell option just like that without having a buy option that is covering, or you don't have the underlying share to cover your backside. So naked selling option is equivalent to naked short selling, where the risk is actually very, very high. But if you are buying an option and selling an option, right, then you actually sort of protect yourself in a way. And sometimes when we do this kind of multiple transaction, right, we can push our risk reward ratio or reduce our risk. So a bull call spread is a two option transaction. One part, we are buying a call option at a particular strike price, usually out of the money strike price. And the other side is we are selling a call option at a higher strike price than the one that we buy. Okay, so it's very simple. You buy a call option like how you will normally do a YOLO option, and then the only additional step is that now you are selling a call option that is a higher strike price than the one that you bought. So it's very simple to understand, but later I will go through the details of it. So this is considered simple because it only requires two transactions. And I can tell you that there are certain option strategy that requires a total of 6 transactions. Sometimes when you when you manage to get all your orders in, right, the strategy already like all over the place already, like you don't even know what's going on already. So this kind of two transaction strategy are considered simple. Like for example, I think the butterfly strategy requires a total of 4 transactions, if I'm not wrong, and there are more complicated ones. So the pros, right? So one thing you must remember is that when you do an option strategy, it must give you additional benefit to say compared to say just buying a simple call option. Okay, so you do not just do a you do not just do an option strategy just for the sake of it. There must be some benefit given a particular situation. So most of the time we will compare it to, say, for example, just buying a call. So do you want to buy a call or do you want to do a bull call spread? So if you are going to do a bull call spread, right, then there must be some advantage that this bull call spread is giving you compared to buying a simple call option. So in this case, right, a bull call spread have limited risk. But the thing is that your call option also have a limited risk, which is your the cost of your option itself. But by doing a bull call spread, right, you can also reduce your risk and your cost drastically compared to just buying the option. So when you reduce your risk and your cost, right, what you are also doing is you are increasing your risk reward ratio by quite a substantial amount. So you can think of it as just by making an additional selling transaction, right, you are drastically reducing your risk, and at the same time you are also increasing your risk reward ratio. So later we will use the VIX trade as an example. Okay, then when the market open, we can execute the trade. So the cons is that there is a limited upside, but we will discuss this more later. So if you just do a call option, the advantage of a simple call option is it actually has unlimited upside, because stocks can go up in a unlimited manner. So because of that, simple call option have unlimited upside. But actually, if you do a bull call spread, right, there is a cap on how much profit that you can get. So we will discuss this more in detail later. So a simple call option theoretically have unlimited upside. So when I say theoretical, right, it's because theoretically a stock can go up indefinitely, but how often does a stock go up in such a manner? Not really that common also. So a bull call spread is best used when you expect the underlying price of the stock to go up, but actually not by a lot. Also, maybe at some point you think that this particular stock will get resisted. Okay, so we are using this strategy on the VIX trade that I have shared earlier today, trade number 66. So if you have not taken a look at the trade yet, right, I do recommend you to go and look at it. It is this particular one, VIX trade. So here I have outlined the call option. So in this strategy, right, there are two options. The first option is to just simply buy the call option itself, which is also it can be done. But if you want to squeeze out more risk reward ratio, right, or if you want to reduce your cost, you can do this bull call spread strategy, and then you can reduce your risk. So I will be going in detail on how you can do it. So the reason why I want to do a bull call spread on VIX is because yes, VIX can actually go up, but I don't think it can go beyond 40. Okay. I mean, yes, it can, but the chances of it going beyond 40 is very, very small, that I will consider that as the limited upside. Okay. So now I am looking at a resistance of 40. So that is where our selling of the call option it will be at. So now just let's look at the trade as a simple call strategy. So we are just buying call option. Okay, so we have a strike at $25. The expiry date is 18 Jan 2023. And the option price is 205. But I think currently the option price have increased by a bit. I think 2.1, 2.2 like that. But when I was looking at it while creating this PowerPoint, right, it was at 205. So if the option expires out of the money, meaning your VIX remain below 25, by 18th of January, right, your VIX remain below 25. So how much are you going to lose? You will lose your entire contract, which is 100 times $2.05, which is your option price. So here, right, I am assuming you only buy one contract. Okay, if you buy two contracts, then you multiply by 2. If you buy 3 contracts, then you multiply by 3. But right now, I'm assuming there's only one contract. So if you just bought one contract, then your maximum risk, right, is $205. That is if your VIX did not go above 25 before the expiry date. So what if the option expire when VIX is at $30? So $30 is our target level 1. Okay, so if VIX hit 30, right, then what you will gain is same thing. You will take the target price, which is $30. You minus off your strike price, which is 25. But you also have to minus off your option cost, because you are paying the options. I mean, your option doesn't come free. You must pay some money for your option also. So 30 minus 25 minus $2.05, and then your option contracts are in multiple of 100, right? You are going to gain $295 if your option expire at $30. Okay, so in this case, right, your risk reward ratio will be about 1.43 because you are gaining $295 and your risk is $205. Okay, still simple to understand. So what if the option expire at $35, meaning this is our target price number 2. So the calculation is the same. Your TP level to 35 minus 25 minus 2.05, which is your option cost, and then multiply by 100, you will get $795 per option contract. So once again, we are carrying the same risk because this is your maximum risk. You cannot lose more than this. So our risk reward ratio is 3.87. So it is very attractive, but of course, maybe it might be hard for VIX to go all the way to 35, but then again, right, who knows, okay? So if you want to calculate your profit, what is your profit at any price level above your strike price, right? You just simply use this formula, okay? So maybe you can use 26, 27, 28, you can just use this same formula. You will get your profit, your projected profit. And what if, let's say, VIX went chung up all the way to 45 like that, which is very unlikely, but we are still going to calculate this anyway because later we will use this as an example when we are comparing it against the bull call spread. Okay, so if VIX go all the way to 45 by the expiry date, you are going to get 45 minus 25, which is your strike, minus your option price 2.05, and then multiply by 100, you will get $1,795 per contract, meaning your risk reward ratio is all the way up to 8.75 like that, which is extremely attractive. Okay, so this is what you will get when we use a simple call option strategy. Just one simple transaction. We are not using any strategy at all. So the higher the VIX goes before your expiry, right, the bigger profit you will get. There is no limit on the upsides. Hence, a simple call option has unlimited gain. But of course, how likely can VIX goes to 45 or maybe even higher? I think VIX hitting 40 is, I would say, quite challenging already. So I don't think VIX can hit 45. So when we say that a simple call option has unlimited upside, right? I mean, there is a caveat, like how high can the price go? Okay, so that's one thing to take note. So now let's do a calculation for bull call spread strategy. Okay, so right now we are doing a little bit different. The first part is the same. We are still buying the call option at the same strike price, same expiry, same option price, which you can see here. Everything is the same, but we have an additional transaction. And the additional transaction is we are also selling a call option at strike $40. The reason why we are selling at strike 40 is because I don't think VIX can go beyond 40. Okay, so that is my resistance level. That is my cap. Maybe VIX can go to 35, so I don't want to sell at 35, but I think VIX will be very hard to go beyond 40. Okay, that's why the second part of the transaction, right, the strike price is at 40. So if we sell the call option at strike for $40 with same expiry date, the option price is 53 cents. The reason why the option price is a lot cheaper is because we are selling a strike price that is extremely out of the money, because it is very hard for VIX to hit 40, right? That's why the option price is very cheap. Okay, if you sell at a lower strike price, right, then of course you are going to get a higher value, higher option price, because you are selling nearer to the current price. Okay, so now we are assuming a 1-to-1 ratio, meaning 1-to-1 as in for every one call option we buy, we are selling one call option. So it is a 1-to-1. So now let's calculate the first scenario. The first scenario is that your VIX remain below $25. Your VIX didn't even go beyond 25. It just remained like below 25 until your expiry. So what you will get is for the first portion, right, it is the same thing. You are going to lose $205 per contract on your buy call option. 100 times 205, you will lose the $205 because your call option expire worthless. But because you sell the call option at $40 strike, right, you will be getting the premium of $53. So in a way, right, you have reduced your risk lah. You have reduced your risk to $152. Initially, if you just do a simple call option, right, your risk is at $205, but now your maximum risk has reduced all the way down to $152. So in this case, right, by using a bull call spread strategy, you have essentially reduced the risk by 25.8% compared to a simple call option. So that is a very big reduction in risk. Okay. So in fact, this is actually your maximum loss. So no matter where VIX goes, right, no matter how low VIX goes, you will not lose more than $152 per contract. So now let's look at other scenario. Okay. So the next scenario is, what if the option expire at 30, meaning VIX expire at 30, which is our target price number 1. So now let's recall back the simple call strategy. If VIX expire at 30, you are going to get $295 profit, and you are risking $205, which should give you a risk reward ratio of 1.43. But you also spend $205 on your contract, right? Meaning your return on your capital is 143%. Okay, so this one easy to understand. Now let's calculate our profit if, let's say, the option expire at 30 VIX expire at 30. So on the buy side, right? So we calculate separately. So on the buy side, it's exactly the same thing. You will get $295, but because 30 is still below your $40 sell strike, your sell side, right, it will still expire worthless, meaning you are going to get the $53 premium also. So your net gain is actually increased by $53 compared to just a simple call option alone, meaning your profit, right, you'll get $348 per contract. So in this case, right, not only you are getting more, you are getting $53 more, but your risk, right, your maximum risk is also $53 lesser, which is going to increase your risk reward ratio to 2.28. And if you just do a simple call strategy, right, it's 1.43. So you can see that there's a very big difference. And your return is actually 228% because you are only spending $152 on your strategy, because you are getting your $53 on your short side. Okay. So now we are going to use the same calculation at a different expiry level. So while bull call spread, right? So initially I say that the cons for the bull call spread strategy is actually limited upside. But even at this level, right, you are already getting 228% return at TP1, and your risk reward ratio is 2.28. So this risk reward ratio is more than enough, even though the bull call spread has a limited upside. We haven't really hit the limited upside yet. So now, what if the option expire at $35? Sorry, the VIX expire at 35, right at the resistance level there. So let's look at the simple call strategy. Let's recall the calculation is 35 minus your strike minus your call option price, and you will get $795 profit per contract, which will give you a risk to reward ratio of 3.87. And since you spend $205 on your option, right, your return is 387%. But what if we use the bull call spread strategy? So on your buy side, you will still get the same amount, $795. But since 35 is still below the 40 strike on the sell side, right, you will still get the $53 added to your total profit. Okay. So in this case, you are going to get $848 because 795 plus 53, and your risk reward ratio is 848 divided by 152 because your overall risk is also reduced. So now you get a risk reward ratio of 5.57, which is so much higher than 3.87. So your return is also a lot higher, 557%. So once again, right, even though we say bull call spread has a limited upside, at TP2, we are already getting 557% return with a risk-reward ratio of 5.57. And that is actually more than enough. It's considered very, very attractive already. So when we say limited upside, right, then where is that limited upside? So what if the option expire at $40? So now this $40, right, it is the same as your sell strike price, okay? It is right at the sell strike price. And this is actually your limited upside. This level is where you will get your maximum profit. So at $40, sorry, there's a typo here. This should be 40. So let's say if the option expire at $40, you will get 40 minus 25 minus 2.05, which is your option price, multiplied by 100, you will get $1,295 per contract. Okay, so your risk reward ratio is 6.31 for a simple call strategy. You will get a return of 331%, which is like crazy high. But let's look at the bull call spread strategy. How much will you get? So on the buy option side, you will still get the same amount, $100,295 per contract. But because the option expires exactly at the strike price, which is 40, your sell side will still expire worthless, meaning you will still get your premium for free at $53 per contract. So in this case, right, you will once again add your 53 to your buy side profit. You will get 1,348 per contract, and you get a risk to reward ratio of 8.86, and your total return is 886%. And actually, this is your limit. This is the highest profit that you can get with a bull call spread on this trade. Because if the VIX go any higher, right, you are going to lose money on the call option that you shorted at strike 40. Okay, so you will start to lose money on this selling portion, which will undo your buy option side. So no matter how high VIX go beyond 40, right, your profit will always be fixed at 100,348, mainly because whatever profit you gain beyond this amount, you are losing that amount on your sell side. Okay, so just to illustrate that, right, what if VIX go all the way to 45? Now 45 is beyond the strike price of your selling call option already. So on the simple call strategy, if VIX option expire at 45, which is highly unlikely, but let's calculate anyway, you will get 45 minus 25, which is your strike price, minus 2.05, which is your option price, multiplied by 100, you will get $1,795 per contract, which give you a risk reward ratio of 8.75. It will give you a return of 875%. But this is highly unlikely. But the only reason why I'm calculating this is to show you that beyond the strike price 40, right, your simple call option will actually give you more return, okay, compared to the bull call spread strategy. So let's look at the bull call spread strategy. So on the buy side, you will still gain the same amount, 1,795 is exactly the same calculation. But on your sell side, right, you are going to start to lose money because now the price is higher than your shorted strike price, okay? It's like how you short sell a stock and then the price go higher, you will lose money. It is exactly the same thing. So in this case, how much are you going to lose? So your strike price minus the current price, which is 45 now, then you add back the 53 cents because you actually got this 53 cents, okay? And then what you will get is you will get negative $447. So you are going to lose $447 on your sell side. So even though your buy side, you got a lot more profit, right? Now your sell side is losing money really. So if you minus off, if we calculate the net gain loss, right, you will still get $1,348 per contract, which is 8.86 risk to reward ratio, and you'll get a total return of 886%. So even at strike price of 45, right, you can see that the simple call option is like slightly, it's even lesser, you know, it's actually even lesser than what we are. Sorry, I think I calculated wrongly here, but anyway, right, my point is that you can see be it beyond 40, right, even if we go to 45, 50, 60, right, your bull call spread will always give you 1,345 already. Okay, so that's the limit of your, that's the cons of a bull call spread strategy lah, where above a certain, above the sell strike price, right, your profit is capped already. But the thing is that even though your upside is limited, you are, the maximum profit that you can get is actually 886% return, which is actually more than enough for one trade. Okay, so let's not be too greedy, and then it is considered good enough. Okay. So this call spread will just buy and sell when market open, don't need to wait for the target price. Target price as in your entry price. Are you talking about the entry price? Okay, let me move forward, and then I will see what's your answer. The only reason why I make this trade is because VIX has fallen enough lah. Okay, so it has fallen to the point where I feel the support level ready, which I feel, and at the same time, there are also other fundamental reasons why I think VIX is going to go up. So it is at the support level, the technical align, the fundamental align. That's the reason why I call this trade today. So it is not like I can anyhow go and place a bull call spread at any random price lah. So yes, the entry price does matter. Entry price does matter. But I mean, whether you get at 20.17, 20.09, or 20.22, it doesn't make a very big difference. But of course, I'm not going to make this trade when VIX is at 30 or VIX is at 27. Okay, so I hope I answer your question. So now let's continue. Okay, so you can even make modification to the trade. What if you sell twice the number of call option at 40 strike? So instead of a 1-to-1 ratio, right? What if for every one call option that you buy, you sell 2 call options? What will the result be? Will the result be any different? And actually, this for every one call you buy at strike 25, you sell 2 call options at strike 40. So you can go and play out the strategy, go and calculate, see what is the difference like. And in fact, this strategy is actually called a bull ratio spread, a 1-to-2 ratio or 1-to-3 ratio. But it is slightly more advanced. I will classify it as more complicated strategy, because now not only you need to figure out where are your strike price, you also need to figure out how much ratio will give you the most optimal result. So I'm not going to cover here. Okay, this one a bit high level already. So if you do this, right, what's going to happen is that you are going to drastically reduce your risk greatly, okay? And then you are also going to increase your risk reward ratio greatly if you do this, but of course it will come at a risk, it will also come at a risk, because if let's say VIX goes beyond 40, right, you will see that your profit will actually reduce. Your profit will no longer be capped, because now you are losing twice as much since you are short selling 2 call option. So there is a downside to whatever strategy you are using now, okay? And then what if we go even more extreme? For every 1 call option you buy, right, you sell 4 call option at strike 40. You can go and work it out to see what you get. So calculate your maximum risk and reward and structure your trade, because don't blindly do strategy just because you just want to do strategy for the sake of it, but make sure that you calculate and see what is the difference and how much are you going to get. So in fact, right, there is a calculator. You can get it from this website. So I'm just going to show you, okay, on how the calculator works, so you can work the value out. And we can also double check to see the stuff that I calculated is correct or not. So this is the website. Okay, so now I'm trading VIX, and then this is the long side. So the long side I'm gonna buy. The option is you can actually select here, okay? You can select shit. Where? Okay, you can 18 Jan strike price 25 currently is at 2.15, 2.2 mid. Okay, I will take the middle price, okay, 2.21. So now since the call option price is different, the calculation will be slightly different now. Okay, so I'm going to buy one contract on the long call option, and then on the short side, right, I am going to sell 40 strike, and then I will take the midpoint 0.54. Okay, so after you do ready, you take the agree to terms and condition, you press calculate, and then you can see your result here. Your entry cost is $167, which is also your maximum risk, 167. Meaning, if VIX is below, if VIX is 25 and below, right, which means below your call strike price, okay, you are going to lose $167 overall. And your maximum return is 133. So your maximum return is always when VIX expire at your short strike price, which is $40, okay. So if it expire at your short strike price, right, you are going to get $1,333, which is going to give you 798% return on your risk. So this is your break-even price. Break-even price is where the VIX need to go in order for you not to lose money. So if VIX is at 26.67, right, then you are not going to lose money if VIX expire at 26.67. So this is the probability of profit, meaning the probability of you getting $1,033 is 13.8%, which is also to say that the probability of VIX going to 40 is 13.8%. But of course, this probability is based on past data, okay, the past volatility level. So which is not really a good measurement because it is not accounting for situation like in the next week we have CPI and FOMC. Then what if during the CPI the market dropped like 3%, suddenly S&P crashed like 300 points? This probability is not accounting for that. So the reason why we are making the trade today is because we have upcoming events that can bring the S&P down, which can make the VIX shoot higher. We got all these events incoming. And not only that, VIX is at a very, very attractive support level where the call options are very, very cheap. So that's the reason why we are making this trade. So just because you use a bull call spread strategy, because you are limiting your downside, it doesn't mean that you can enter any stock at any price and you use the strategy, you 100% win really. It is not like that. You still need all your analysis, but once you got your analysis correct, what the strategy is going to do is it's going to allow you to squeeze more profit out from your trade. Okay. So in fact, right, you can actually look at this table. This table will show you how much profit you can get. So when remember that when we are calculating all the profit, loss, all this stuff, right? We are actually calculating at the expiry date. We are looking at what if this option expire at this price. But of course, you don't really need to wait for option to expire. You can actually exit earlier. But when you exit earlier, right, your option price will be slightly different. So by using this calculator, right, it will kind of give you agak-agak. Okay, these are not fixed. These are not confirmed chop number. These are agak-agak number. So what if VIX hit 36 at 4th of January? If VIX hit 36 at 4th of January, you are going to get 423% return and your approximate profit is $707. That is on the risk of 167. Okay. And then anywhere below here are your loss. Okay. For example, you can see that all this here, right, is you will get 100% loss, meaning you will lose your entire option contract, which is 167. So your maximum risk is 167. So you can come here and play around with it. You don't need to do manual calculation. So just now, I mentioned what if I do a ratio of 1 to 2? What if I, for every one contract that I buy, I short sell 2 contracts? What will happen? So we can like see what will happen. 2, and then okay. So if you click 2 here, right, it will also change to here, okay. So I'm going to change this to 1. Okay, and calculate. And then what you will see is my entry cost is now reduced to $113. Just now it was 167, but now it is reduced all the way to $113 lah. And you'll also see that my maximum return is 1,387. But one thing you will notice is now the maximum risk is infinite already, because even though it says infinite, right, you can calculate lah. Okay. So if VIX go beyond a certain level, if VIX go beyond a certain level, because you are short selling 2 contracts, you will start to lose more and more and more. Like, and I think at some point, right, your loss will be more than what you gain from your long position. Okay. But I think in order for you to lose infinite amount, right, VIX have to go to like 500 or 1,000, a very, very high level. So in this case, you will see that it is not really showing you. It's not really showing you what is your risk-reward ratio and all this kind of stuff. So the thing about doing a 1:2 ratio is that firstly, your entry cost is reduced drastically, but at the same time, right, your risk-reward ratio is going to skyrocket simply because of the fact that your entry cost is reduced drastically. Okay. But this maximum risk infinite is a little bit 夸张. It is better for you to look at this chart manually. Okay, so you can see that here here you can see a negative, meaning if tomorrow VIX go to 39.75, right, you are going to lose $20 simply because of the fact that you have two short position on your call. Okay, so you can kind of like work this out. But as long as VIX expire below 40, right? As long as VIX expire below 40, you will still get your maximum return. And because now your entry cost is drastically lower, your risk-reward ratio will be very, very high. Because now the risk-reward ratio is 1,387 divided by 113. Compared to, let's say just now, right? If I just have 1 contract, it will be 1,333 divided by 167, which is the risk-reward ratio is not as attractive. Okay. And you can see that once I switch to 1:1, right? Once I switch to 1:1 ratio, this part here is no longer red. Actually, you're gonna get 406% if VIX hit 39 tomorrow. Okay. Although highly unlikely, but you can see how the difference is. So what if I do a 1:4? I do a 1:4. So if I do a 1:4, you can see how things get extremely drastic. But the thing is, if you do 1:4, right, you'll realize that your short side, you are getting more than what you spend on your long side. You can see that entry cost is now positive $5. Is it positive $5? Okay, yeah. So now you're only now you are only spending $5 on your entry cost, and then your maximum risk is like 1,495. So now your risk-reward ratio is even higher lah. But you will see that if VIX is above a certain level at certain date, right, you are going to lose quite a lot of money lah. Okay, so you can see that if you sell more, it's going to come at a cost lah. So you can see how the structure change. So usually, right, what I will recommend if you are doing a bull call spread is to just do a 1:1 ratio. I think 1:1 ratio is the best ratio lah. It is less complicated, and your risk to reward ratio is very, very good already. So do play around with it. So now we are using VIX as our live trade for today, but actually you can apply this to almost every single stock trades that we are doing. So for example, right, let me show you. Okay, now almost 10 now. So let's say I want to trade Shoals Technology, for example. Let's say I want to trade Shoals Technology, and I think shows technology, you can go there lah. So that's my TP price lah. Okay, let's say this is my TP price. Oops, 32. Okay lah, 31 lah. Okay. And then let's say I want to buy. So this is my TP. Then let's say this is my strike. 27 is my strike. Okay, so now I got the buy side ready. I want to see at what strike I want to do the sell side. So usually, right, of course, you will want it is your upper limit lah. Okay, so you will want it to be above a resistance level lah. So in this case, right, I can choose here. I can choose 35. I can choose 35 as oops. I can choose 35 as my sell side. Okay, so now let's calculate. Let's use the this calculator to see what is our maximum profit, maximum loss, or whatever lah. Okay, so in this case, right, we also need to think about expiry. So for this case, my TP is actually 24% for my entry. So I don't think I need a very long dated expiry. Maybe like 1 month out should be fine. So let's go and find the stock SHLS. Can they find it? Okay, 24.79. Okay, yeah, I think about there lah. Agak lah, okay. So on the long call, let me find lah. Let me find the price lah. Let me manually enter the price. Okay. Well, give me a moment. Oops. Options. Okay, I'm going to choose January 20th of January lah. Okay, 20th of January, and the option on 20th of January for strike price 27. Okay, there's no 27. There's no 27. There's 30 though. I think 30 is actually too far out. So 25 lah. I do 25 lah. There's only 25, no 27. 25 is like in the money. Okay, because this counter a bit ulu, so there's limited option. Yeah, so we buy at 25, okay? So the strike price for 25 at 20th of January expiry is 2.85. 2.85. Okay, and then I'm going to sell the option at strike price 35. So 35 is 0.45. Okay, 0.40. Let me choose the middle price. Okay. So now calculate. Please complete all required field. What else do I need? Well, let me refresh. Price range. Okay, here. 20th Jan. I'm buying the 25, 2.81. And I'm selling the 35, 2.41. Okay, so calculate. Okay, so in this case, you will see that my entry cost is $240 because 281 minus 41, I get 240. My maximum return mean the show go all the way to 35. Okay, show go all the way to 35 is my maximum return. So that is $760. That's my maximum return. But my profit is only at, I put my TP level at $31. Okay, $31. So let's see how much I can get at $31. $31 is here. If shows go to 31 by expiry, right, I will get 150% return, which is to $360. So that is like I am spending 240 on a $360 profit. So the risk reward ratio is not really there, but still I think maybe it is a lot better than just buying a simple call option also, because you are actually reducing your risk now. Okay, but let's say if it goes all the way to like $35, then of course you'll be getting 317% risk. So you can kind of use this to calculate your total risk and reward. But of course, I mean, if you have a lot of capital, you can buy a lot more then of course things might be different Then you have like you are risking 1,200 for $1,800 profit, which is kind of like a bit okay. So sometimes, right, it could be because this stock, right, this particular stock is a little bit ulu, so the option price can be slightly expensive, the spread can be expensive. That's why the price are not very good okay. So for counter like VIX, right, VIX is a very popular ETF that a lot of people trade, so your spread are a lot better, the pricing is a lot better. So that is what I mean by that. Sometimes, right, it is not always good to use strategy. Don't blindly use. For example, in this case, right, what if I buy here and then my stop loss I put like 20, I put like 21, and then let's say my target is 31. So in this case, I'm risking 15%, but I'll be able to get about 28%, which is quite close to risk reward ratio of 2 I think I can get about 1.8, 1.9 risk reward ratio simply by playing long position. Don't even use any option okay, which seems to be a better let's say a better choice than playing a bull call spread okay. And then what if the price go all the way to 35? What if the price go all the way to 35? Then it will be about 15 to about 40. So my risk reward ratio is about 2 point something. In this case, you can see that the bull call spread is better. So in a way, right, your TP level also matters. So there's a lot of there's quite a lot of variables involved also Yeah, VIX is the future. If you are looking at the ETF, then it's UBXY Okay, so that is basically all for the option strategy okay. So do go and play around, do go and work it out. Then next time we will go through the put option version of this particular strategy. So it's called the bull call spread, and then the other one is called the bear put spread We are doing the opposite direction. So what you will also notice is that sometimes for stocks, right, a bull call spread is not really as effective, especially when you get a very good stop loss. But in this case, right, you can see that the stop loss at 21 may not be very good. So what happened here is maybe you may want to go for an option, because option doesn't really care where your stop loss is it can go all the way down and then suddenly come back up like that, but you are still risking the same okay. So these are stuff that you need to consider. So yeah, that will be all for today's lesson. So hopefully it's something that you can use in the future. So any question before I end the session? Today like quite bare. Really, WWE dropped quite hard. Let's check. These are the news. Currently, there's no. Wait, it's already 10 p.m. This one got the pre-market price ready, but WWE don't have pre-market price yet. Why did they drop pre-market a lot? WWE. Tiger say it dropped by 4.99, which is 76 here. Don't know, I don't trust Tiger pre-market price. Because there are a lot of time I see Royal Gold pre-market went up 5%, but in the end also no, it's just like a bit only. I don't know. We see when it opens lah. We see when it opens. Wow, Susan, we already finished the entire thing, like we already finished the entire thing already. So I don't think I can repeat the 1 whole hour worth of stuff lah. but I was going through, but just to summarize for you, right? I was just going through the risk reward of, let's say, if you do a bull call spread compared to just doing a call option lah. Okay, if you do a bull call spread, what you are doing is you are buying the strike 25, but you are selling the strike 40. So that's essentially what you are doing now. But of course, if you are unfamiliar with it, then I don't recommend you to rush in, because I will upload the video later at night. You can look at it tomorrow, and then if the VIX is still at this level, right, tomorrow you can enter with much better knowledge. Okay, so later when the market open, right, I'm going to enter my trade now. Okay, so you can also enter your trade. So I'm not sure if you can enter the VIX option without having future, but just now I don't have access to futures on Tiger also, but I did enter the option order and I think it went through lah. Okay, so most likely if you have option activated on your Tiger, you can still get the VIX option, but you cannot buy the VIX if you do not have futures. So do take note of that. Or maybe Interactive Broker may be different. Let me just double check UVXY. Oh, UVXY is the short ETF. Yeah. I don't. If you are playing UVXY, right? I don't recommend option. Just buy the UVXY can already, because when you are doing option on something that already have a 1.5 times leverage, right? It can get very crazy. It can get very, very crazy. Yeah, it also has a higher decay lah. Okay, just now, right? Earlier in the morning, I have not post the spread trade for post holding long versus bunch limited. So you can go and take the trade. Yeah, some do long 150 VIX. Some do got a call option at 150 VIX. But because it was so out of the money, right? It cost like only 20 cents or 25 cents. And I think at some point that guy was actually in the money. In the money as in the option, it didn't hit the strike price, but the option actually was profitable. Simply because the option price is so cheap. Okay, Zoom is going down also 0.82, Palantir going down 0.91, Whirlpool, no pre-market, Construction Partner, no pre-market. But I don't think that guy was from Wall Street Bets. That one we spotted that using the unusual option activity. But it was also uploaded on Wall Street Bets. Royal Gold, no action. You can see that pre-market price for counters like WWE, if you look at the spread, right, it's ridiculous. You see, is the buy price is all the way at 72.94. So if someone is selling into that, right, it is like all the way here. And if someone is buying, right, it's like 87.99, which is all the way there. So I don't think anybody is trading counters like WWE at pre-market. Or if someone actually traded, right, then maybe that person itchy finger, and then because of the big spread, the price go all the way down, but it can usually immediately recover back. It is usually due to this big spread. So I'm not worried too much about it, and I don't think there's anything that makes it go down, should makes it go down so much also. Wow, WWE outperformance tied to 100% increase in US right renewal fee. Crazy. Okay, guys. If no question regarding the options, right? I'm going to end this, okay, so that I can upload this quickly, so whoever want to watch can watch lah. Okay, guys. So all the best on your trade. Be careful. This week maybe not so kanchong, but be careful for next week. Okay, don't have very dogmatic in your direction lah. Don't go 100% short or 100% long, and then both sides you will get caught lah. Okay, guys. Thank you very much. Bye bye.